So that takes us to, I think cash and cash flow is clear now. For cash, the liquid we have, the amount of money we have here in the hand or deposited in the financial institution, that is cash. Minus the bank overdraft, because the bank overdraft is a liability. You have to pay back the bank. It's a short-term liability, a short-term debt that you have to pay back to the bank. So it's not your cash, so it does not belong to you. Cash flow is about the transactions. As soon as the transaction is done, I'm talking here, as soon as the transaction is done, your cash is either going to increase or decrease. It depends on the nature of the transaction. If I am buying from you, your cash increases, my cash reduces. If you are buying from me, my cash increases, your cash reduces. Cash flow. Inflow and outflow of cash. The statement is about receipts and payments. I think it's clear. So that takes us to the purpose and benefits of cash flow statements. Why do we have to prepare a cash flow statement? And what is the reason for preparing it? Number one, to show inflows and outflows. Remember I said here that a cash flow statement is about what? Receipts and payment. So if it's about receipt and payment, receipt means what? Inflows. No, sorry. Payment, sorry. Yeah, receipt means inflows for the business. And payment means outflows for the business. Receipt means you have received cash. And that is an evidence of payment. So if I have paid you, it means you have to issue a receipt. If I bought on credit, it means I need what? Invoice. It will never be in the cash flow statement. Because cash flow statement represents the actual cash generated in the course of a transaction, or the actual cash spent in the course of a transaction. So your revenue, what comes into the business, is your receipts. Your expenses are your payments in cash. Are we getting it, please? So the first purpose of having a cash flow statement is to know the actual cash inflow and the actual cash outflows. Inflow, receipt, outflow, payment. What comes into the business and what goes out of the business. Do you understand the first purpose here? Do you understand or not, please? The second one, to predict future cash flows. We have what we call the cash flow forecast. What do I call it? Cash flow forecast. It is an estimated amount of cash that we are expected to make in the future, and the estimated amount of cash that we are expected to spend over the future. So, how do you get these estimates? You get this estimate through a research or historic data. I'm going to read that again. Are you guys here? Yeah. Here, the second one I said, it predicts future cash flows, inflow and outflow. So the estimate of what we are expected to make over a period of time in the nearest future. So how do we get this information? We can get this information through what? Historic data. Oh, last month, this is what we make. Oh, this time last year, this is what we make. So it is expected of us to make almost the same for this year. Is it making sense here? That is historic data. We can also make an estimate based on research. When you're making a forecast is about you making an expected evaluation about the future. So how do you make evaluation about the future? You make evaluation about the future through past records or market research. Do we understand the second one here now? So the second one is that a cash flow statement can allow us to estimate the expected inflow and outflow of the future. Is it clear?
Yes.
Any question up to now?
No.
Are you here?
Yes, you.
Okay. I'm saying mine now because this is the time for you to ask.
Yeah.
Not in the exam hall. I will not be there like I am not always going to be there. That is the reality. Are you here?
Yes.
Great. The third one to help financial planning. One of the problems businesses do have is cash shortage. And most of the time they have this cash shortage because they do not have a structured plan. If you fail to plan, you are planning to fail. So if you do not plan on how to spend your money, you will be out of money. Do you understand? So because you have a cash flow statement that you forecasted, it allows you to know how to spend your cash. So the third one talks about what? Financial planning, which is what? Budgets. A financial plan is what? Your budget. The expected revenue and the expected expenditure over a period of time. With your cash flow statement, it allows you to make a financial plan. And what is a financial plan? Budget. What is a financial plan here? Hello? What is a financial plan here? I said a budget. A budget is a financial plan on revenue and expenditure. Do we get it here? The next one, to assess liquidity and solvency. This is where we're going. Liquidity and solvency. The financial statement or the statement of cash flow allows us, tells us, because it's about liquidity. It's about liquid. So it tells us if we have the ability to pay our debts of now and we have the ability to pay our financial commitments in the future. One thing is this. If your attention is in the classroom, exams will not be difficult. Students loses out marks because they are not attentive. Yes, you might be here, but you are out there. If you are here and out there, I'm sorry, you're not going to pass the exams. Because the details are in here, not out there. It's not about just sitting down and focus, looking at me. It's about sitting down and focusing. And start questioning the questions. Come up with curiosities. Ask. Not that I'm just going to continue to talk and you don't ask questions. You're not asking, you're not making notes. Please, details are important. That is my advice from me to you. The next one is about liquidity and solvency. Because it's about cash flow statements, it talks about what we have right now and what we have in the bank. So, what about liquidity there? It is a company's ability to convert assets into cash to cover short-term financial obligations. We need to pay our creditors. We need to pay wages. We need to pay utility bills. We need to pay electricity. We need to pay all these things. We need to pay these things at a short period of time. Yes or no?
Yes.
Without liquidity, it becomes difficult for us to pay. That's about liquidity. There's a difference between liquidity and solvency. Liquidity is about you having cash to sort your short-term debts. You need to pay your creditors, you need to pay wages. All these things will come within a short period of time. If you are able to do that with cash, that means the company has liquidity. Do you understand liquidity here? And how are you going to know if you have enough cash? You get to know if you have enough cash with what? Your cash flow statement. Because your cash flow statement talks about your inflow of cash and outflow of cash. Your net cash. So your net cash flow tells you if you have cash or not. So if you have cash now, it simply means you can pay off your short-term financial obligations. But if you have a negative net cash flow, it simply means you won't be able to pay off your financial obligations in the short term. Yes?
Doesn't the balance sheet already say that?
No, the balance sheet will only talk about your cash.
Yeah.
It doesn't talk about the receipts and the payments. Do you get it? So that's why we said the only statement that talks mostly about the actual cash generated is the cash flow statement. Do you get it now? So your statement of financial position will only talk about the actual cash. But how the cash is being generated, you're not going to find it in your statement of financial position. You only find it in the statement of cash flow. It talks about how the cash you find in your statement of financial position, how it's being generated. Do you get it? So that's about liquidity. Any question about liquidity here? Liquidity is the ability of a business or a company to be able to pay its short-term debts or short-term financial obligations. Any question about liquidity? Any question about liquidity? No, good. Then we go to solvency. For solvency, we're talking about a company's ability or financial capability to be able to pay its long-term obligations, buy equipment, expand your business. These are long-term financial obligations. They are not in the short term. Expansion, merger, acquisition, buying other businesses, paying dividends. Are we getting the difference between solvency and liquidity? Liquidity is about you being able to pay your short-term financial obligations. Solvency is about your financial capability to pay or to buy or to spend more cash in the future. If you need to buy a building for your company, can you take an overdraft, a bank overdraft to buy it? Can you use a bank overdraft? I have a bank overdraft somewhere. You have to take a loan, thank you. You can't use a bank overdraft.
Because it's a big amount of money.
Yes. So that means we're talking about long-term financial capability. You can't use a bank overdraft for that. So when it comes to solvency, it's about your ability to procure long-term assets in the future. Do you get the difference between solvency and liquidity? Any question about it? Any question about solvency and liquidity? Good. Then we have the last one, which is to show that cash and profit are not always going to be the same. Cash is not the same as profit. Cash generated would allow us to make profit, yes. But cash and profit are not the same. Because a business can still make profit and at the same time not have cash. Because you might have bought some goods on credit that you have not paid for. And your profit is based on your statement of profit or loss. Not about your cash flow statements. Here you just want to know the amount of money you make and the amount of money you spend. Here, the money that belongs to you or does not belong to you, you wouldn't mind. That's why we have the debtors, the creditors there. But here we're talking about cash, the actual money we spent or the actual money we have. So if I'm buying on credit, it simply means it does not affect my cash, but it will affect my profit. Does it make sense or not? If I buy on credit, do I spend cash? No. But it will be part of my purchases. Did you get it?
Yeah.
When you buy on credit, your cash is still intact. Your cash is still intact. You bought on credit. It's not going to increase or decrease your cash. But it increases your liability. And it will reflect in your profits. Because whatever you buy, you sell. Does it make sense or not? When you buy on credit, it does not affect your cash. The only time your cash increases or decreases is when you make a payment or when you receive cash. When you buy on credit, it doesn't have anything to do with your cash. Just the same as overdraft, a bank overdraft. A bank overdraft does not increase your cash, and it does not decrease your cash. That's why they say cash is what? It refers to that money that you have in the bank or at hand, minus your bank overdraft. Same, because a bank overdraft is a credit. Same goes to when you buy on credit. When you buy on credit, your asset of stocks increases. It does not affect your cash because you did not pay. But when you pay for those stocks, your asset of cash reduces. So that means as soon as you purchase on credit, it does not have any impact on your cash. And that is why cash would not be the same as profit. Does it finally make sense now? Great. So what are the importance of cash flow statement? Number one, it allows the business to assess its liquidity. Because you know your net cash flow, it means you would know as a business or as a company if you have cash or not. It's a reality check. What do I call it? Reality check. You know, it's what is in you, what is presented to you. Oh, we have cash or we don't have cash. If you are having a negative figure, it means you don't have cash. If you have a positive figure, it means you have cash. And your net cash flow is what? Your cash outflow minus your cash inflow. What comes in minus what goes out is your net cash flow. So this allows you to know if you have asset, if you have as cash or not. Do you understand the first one here, please? Do you understand the first or not? The second one, allowing the business into future prospects with your net cash flow. It allows you to plan ahead of time. Oh, are we going to be able to survive this period or not? You get to know through cash. Because cash is the lifeblood of a business. Do you get what I mean here? Cash is what? The lifeblood of it. Without blood, we're gone.
Yeah.
So without cash, we don't have a prospect. The third one, enabling the owners to make decisions about the future and relationship with the business. With cash flow statements, the owners of the business would know if the business is making sense or not making sense. Does it make sense here or not? So if the business is running out of cash, you get to know through your cash flow statement. And that tells you, as the owner of a business, to start looking for how to generate cash. Oh, maybe we have to take a loan now. Maybe we need an overdraft. Because our net cash is negative. We need cash for the future. Or we need to pay our workers at the end of the month, but we don't have cash. We don't have enough cash. Or we need to take a bank overdraft. So make decisions. As owners of the business, you are going to be able to make decisions about cash because you have a cash flow statement. Is it making sense or not?
Mister,
Yes?
do you have to pay any interest on overdraft or no?
Overdraft? Yes, mostly yes, you have to pay. But not that much. Banks will not just give you money for free. Because the money they give to you is a liability to them. As soon as you deposit your money into the bank will start finding a way to use the money to make money. We call it money creation. What do I call it? Money creation. Oh, thank you. But it's not for me, I have one. We call it money creation. Do you get it? Banks use our money to create money. Is it making sense? That is economics anyway, it's a way back. But I'm just explaining to you. So if they don't get interest on whatever they give out, then how do they make money? How are they in business? Clear? The next one, showing how a business can have a bank overdraft and yet make profit. Yes, you can still have a bank overdraft, you can still have your creditors and still make money, and still make profit, sorry. So that's why we said a bank overdraft, cash, profit are not always going to be the same. You can still take a bank overdraft and still make profit because your bank overdraft will be recorded in your statement of financial position. Yes or no? And the interest will be recorded in your statement of profit or loss account as an expenses. It does not reflect on the cash you have at hand or the one in the bank. Any question about this? Thank you.